Hey everyone, welcome back to the channel. I'm your host Ian, and if you're new here, this is where we break down the ins and outs of Canadian history, its economy, politics, and real estate to give you a deeper understanding of what shapes Canada. Today we're tackling the growth of mortgage insurance in Canada with a focus on the Canada Mortgage and Housing Corporation, or CMHC. We'll look at its massive economic footprint, how it enables riskier loans that boost home sales, and the double-edged sword of how efforts to improve affordability might actually be driving up demand and prices. Let's get into it. First off, quick primer on what CMHC is and why it's important. Established back in 1946 as a Central Mortgage and Housing Corporation, it was created to address the housing shortage after World War II. Veterans were returning home, families were growing, and Canada needed a way to make homeownership more accessible. Over the decades, it evolved into the Canada Mortgage and Housing Corporation in 1979. Today, it's a crown corporation that plays a central role in our housing finance system. Its main job in the mortgage space is to provide insurance on loans where buyers put down less than 20% of the purchase price. This protects lenders if a borrower defaults, making it safer for banks to approve those loans. Now, let's talk about the sheer economic scale of CMHC's mortgage insurance operations. This isn't some small program helping out a few people. It's a cornerstone of Canada's financial landscape. As of the end of 2024, CMHC's total insurance in force, that's the value of all the mortgages it's currently backing, stood at about $440 billion. That's up from $414 billion the year before, showing steady growth even in challenging markets. To put that in perspective, the legislative cap for CMHC insurance activities is $750 billion. So there's actually plenty of room for more expansion if needed. In the first quarter of 2025 alone, they insured over 10,000 transactional homeowner units, a 37% jump from the same period in 2024. And it's not just homeowners. CMHC is the sole provider of mortgage insurance for multi-unit residential properties like apartments and condos, which has been a boom in the recent years. This insurance covers everything from single-family homes to large rental developments, and it's funded through premiums paid by borrowers, typically added right into the mortgage payments. CMHC's activities help stabilize the financial system by spreading risk. During crises like the 2008 financial meltdown or the early days of the pandemic, programs like the Insured Mortgage Purchase Program allowed the government to buy up to $150 billion in insured mortgages to keep credit flowing. Without this backstop, lenders might pull back, leading to fewer loans and a potential freeze in the housing market. But on the flip side, this massive involvement in CMHC influences everything from interest rates to construction activity. For instance, their insurance enables lower borrowing costs for multi-unit projects, which in theory should encourage more building and help with supply. That brings us to how mortgage insurance opens the door to riskier loans and in turn, more home sales. In Canada, if you're buying a home with less than 20% down, you need mortgage default insurance, often called CMHC insurance, though private insurers like Sagan and Canada Guarantee handle some of it too. The minimum down payment can be as low as 5% for homes under $500,000. This results in high loan-to-value ratios, which are inherently riskier because there's less equity cushion if property values drop or the borrowers run into financial trouble. So why is this risky? Well, from the lender's perspective, a borrower with a tiny down payment might be more likely to default if life throws a curveball, like job loss or rising interest rates. But the insurance shifts that risk to CMHC or the private insurer, making banks more willing to approve these loans. It's like a safety net that encourages lending to first-time buyers, low-income households, or those without big savings. And because of this, more people can enter the market who otherwise couldn't. Studies show that mortgage insurance expands access to credit, leading to higher home sale volumes. For example, during economic upswings, this can supercharge activity. Think of the buying frenzy we saw in the low rate environment of the early 2020s, where insured mortgages helped fuel record sales. But here's where it gets interesting and a bit counterintuitive. CMHC's push for affordability through these insured loans may have inadvertently caused demand to surge and prices decline. The original intent was noble: make homeownership more attainable by lowering the entry barrier. Back in the post-war era, it helped build the middle class by getting families into homes sooner. Today, programs like CMHC's multi-unit insurance aim to boost rental supply and keep costs down. It does help individuals. You can buy with 5% down instead of scraping together 20%. However, when you make it easier for more people to buy, you ramp up demand without necessarily matching it with supply. Economists point out that this can create a feedback loop. More buyers compete for the same homes, bidding wars ensue, and prices rise. In Canada, we've seen this play out over decades. House prices have outpaced income growth significantly since the 2000s, partly because insured mortgages brought in waves of new buyers. CMHC itself has acknowledged supply shortages in recent reports, estimating gaps that could take years to close, even as they forecast modest price increases in 2025 amid economic uncertainty. Add in factors like low interest rates in the past, and you get bubbles where affordability worsens for the very people that program aims to help. For instance, recent rule changes allowing 30-year amortization for first-time buyers on insured mortgages are expected to boost sales and prices by 2 to 4% by the end of 2025. It's a classic case of good intentions meeting unintended consequences. CMHC has tightened rules at times as well, like raising minimum credit scores or stress test requirements to cool things down and reduce the risk. But overall, the system has made our market more dynamic, for better or for worse. In high demand areas, this demand pressure exacerbates inequality. Those who get in early benefit from rising equity, with latecomers facing steeper prices. That's all I got for today. Thanks for watching. If this gave you a clear view of how mortgage insurance shapes our market, hit that like button, subscribe for more deep dive, and drop a comment. Have you used CMHC insurance, or do you think it's helped or hurt affordability? Until next time, my name is Ian. Stay informed and happy house hunting.